All right, everybody, welcome back. In this video, we're going to do another tip and trick on options trading. Let's go ahead and continue to focus on day trading at the moment. So another tip on when we are trading options on the intraday, and we are trying to get an idea of our risk and our reward and gauge what kind of a move we need to see out of the market and where we should be buying. Suppose, for an example, that we want to first focus on mark, just like we discussed in the last video, right? So we're going to look at the mark, and we're going to look at the discussion about, should I buy the 170, which is inside, it's in the money, or should I use something out of the money, maybe like something, the 175? Which one of these would be a better buy? Which one would do me better in the move in the market? How big of a market move am I actually anticipating? That's going to help a lot. Of course, liquidity is a big deal, so we would already have known or understood that we are trading in a liquid market. That's not an issue. The market's not open yet, so there's no volume to look at. Which one of these two calls would be a better choice? And if I take that trade, which one has a better risk to reward or may help me hit my goal faster? So let's just start with the 170. The 170 is $5.10, right? That's the mid or the mark. In a $2.50 move in Apple, what would this thing pay me, right? How much could I anticipate in a $2 move if I'm right and it moves in the right direction? 6.77 would be the payout if we move $2.50 in the right direction. Now, what I do when I'm trading live in the market is I round down and I round up just so that I can do quick math. Instead of saying 510, in my mind, I just see $5. And instead of saying 677, in my mind, I just say 675. So if I paid $5 when I bought it and I sell it for 675, then I can see I'll make $1.75 if I'm right. What if I'm wrong? What if I'm wrong and we actually go the wrong direction? We go the other way. Well, that price is $3.70. So if I'm right, we're going to go to 675. And if I'm wrong, we're going to go to $3.70. Well, again, we can do that math, right? If I bought it for $5 and I sell it for $3.70 in a loss, if I'm wrong, then I'm going to lose $1.30. So now I can see $1.75 if I'm right, and I can see $1.30 if I'm wrong. It's not quite a 1-to-1 risk to reward ratio, right? We have less at risk than we are expected to see in profit. Now, this is not a perfect way of doing things. We rounded, right? So rounding alone says we're not going to be spot on perfect. And then how fast we go from 170 to 172.5 or from 170 to 167.5. It's not just did we go there, it's how fast did we go there? Because options in the short duration, their value changes very frequently based on buying and selling within that option, the scope and pace of the tape. So if we make that move very fast and we have a lot of participants in here trading with us, these values will change a lot faster. But there is also the concept of strike price shift differential, which is what we're looking at, right? So if I buy the 170 call for $5 and we get a $2.50 move in Apple, I have an expectation of making $1.75 if I'm right, and I have an expectation of losing $1.30 if I'm wrong. So now you can see I don't necessarily need a stop. I can just watch the price of Apple after I get in it. I know that I just priced a $2.50 move. If it fades against me and I'm looking at the chart and I really don't see that that it's telling me I'm right, I don't need to let it continue to move against me. I can just go ahead and get out. But before I ever got in, I could price what's the real expectation of risk here. From our current location, a $2.50 move would put us at around 174.5, at least, from where we had closed yesterday at 172 flat. That's really because the market's closed. That's what we were pricing, was way back there at the close. 172 flat. Still, a $2.50 move would put us right around in that area. So it would be higher than yesterday's open, but still inside yesterday's range. I don't think we're asking for too much to expect a market to be able to reclaim or move towards the previous day's high. That's a fair and accurate assessment. Our lows side could be based on a lot of things. We don't necessarily have to give it a full $2.50 move to the downside to go against us before we get out, but we can price in that risk. We can look at it and ask the question, well, we're spending $5 on a chance or an opportunity to make $1.30. Do we think that that's a fair risk to reward value? Out of this $5, what am I really risking? Right? I'm risking 130 of that to make 175. Could I choose a different number? Right? We were looking at the 170. Let's look at the 175 instead. So that was the 170 strike. We'll just go down a little bit and we'll look at the 175 strike. The 175 strike is pricing in at 256. I'm going to just round it and say 250 because that's exactly what I would do in the middle of the day. That's the midpoint. If I bought that call for 250 a piece and we make a $2.50 move in the right direction, what I bought for 250, I could sell for 370. And if I'm wrong, I can sell it for $1.75. So 370. Simple math again. If I bought it at 250 and I sell it for 370, then I made $1.20. Or I could have an expectation of making $1.20. And if I bought it for 250 and I'm wrong and I lose and I close it at $1.75, then I lost 75 cents. So this is a lot closer to a 2-to-1. It's not a 2-to-1, but it's a lot closer. If I'm wrong, I'm going to lose 75 cents. And if I'm right, I'm going to make $1.20. So it almost has its own built-in risk to reward. Now, which one of these is the better buy? Should I buy the 175 or should I buy the 170? If I'm only looking at how much money I'm going to make physically, like how many dollars will I make, then the 170 is going to make me more dollars. But what if I'm looking at it from a different perspective and I'm talking about percentages? In this situation, the 175 is a better trade. Percentage wise, it's going to do me more, right? I can buy 2 of these for the price of 1 of those. That's the first kick, right? I can literally buy 2 calls at the 175 for the same amount of risk as if I had bought just 1 of the 170s. Now that I have 2 calls, I can fade my risk, right? I can lock in gains with 1 trade and then hold the other one longer to see how far I can get with it, right? Then on the risk to reward side of things, this one's got a much better risk to reward. So I can get more of them. It has a built-in risk to reward that is going to manage me better. And profit and loss wise, I mean, per dollar, it's not that bad, right? We're talking about $1.75 if I'm right, or $1.20 if I'm right. Now that is a lot of money, but if I can buy 2 of these, it's not $1.20 profit, right? It's $2.40 profit. So if I'm carrying that same $5 risk, this trade down here is the better trade. Now, a lot of other factors come into play. These videos are designed to be short and sweet and just offer quick tips. So we're not going to get into all those other factors today, but I wanted to give you guys something to think about. And I wanted to point out what I look at when I'm trying to make a decision about, well, which strike should I get? The answer to that is, what strike should I get this time in this market? You don't always want to go in the money, and you most certainly don't always want to go out of the money, but you do want to try to price which one of these this time is going to be a better trade for me. I appreciate you guys. look forward to seeing you at the next video.